More and more, it appears that the car business will be the final straw for what's left of strength in the global economy, the final tipping point which finally pushes everything over the edge. Sales have stalled, revenues are down, production is being cut, and then the layoffs. And as bad as that is, it's actually an even bigger deal than it seems. And it is one key reason why we're getting more ugly signals looking ahead. The bond market is raising credit spreads on automakers themselves, which is never a good sign. Oil prices are crashing again. The copper to gold ratio just hit another new low, falling below a critical threshold for the first time in years. The auto industry had been one of the few legitimate sources of counter-cyclical strength because it struggled to come back from the supply shock. But once it finally did, the rest of the global goods economy was already in its downturn. So rapidly recovering car sales and production offered an absolutely critical level of support when it was badly needed. We've heard the economy called a vibe recession. I've said it was a half recession, and this is one reason why it hadn't gone the full measure. Others have said it was a rolling recession, which is a pretty accurate term in this context. In other words, unlike in a more typical recession cycle when pretty much the whole economy sinks at the same time, the unique circumstances of the supply shock have meant different parts of the economy have shrunk at different times since the latter half of 2022. It can never get going because there's always the next segment dragging it down, but that has also meant the world has avoided that one big final shove into a uniform macro destruction, and autos have had a lot to do with that. So if the car business is finally ready to roll itself into the rolling recession, that very well could be, if it isn't already, the final straw turning the vibe half recession into the full thing. And ironically, it was ECB President Christine Lagarde who really spilled the beans here. Asked on Thursday after the ECB voted to cut rates here in October, after just a couple weeks ago they said, October's not in our schedule, we prefer to wait for December. She was asked whether it was inflation or the economy that finally convinced policymakers they needed to accelerate their schedule. And she said, it's the same story. It's all heading in the same direction, downwards. Ouch. And that's certainly the case for copper to gold and all these other markets. Despite the fact that copper is up on a little bit of China stimulus euphoria that has come down from its high, the copper to gold ratio, with gold prices hitting record highs here, the copper to gold ratio is now under 0.01% for the first time in several years, pushing further and further into that same dark comparisons with 2020 or 2016 or December 2008 and February, March of 2009. So the copper to gold ratio is falling despite the fact that central banks are cutting rates. The Chinese are doing everything they possibly can, at least that's what they're claiming, to get the Chinese economy restarted. What seems to be carrying the markets is that realization central banks and central governments are responding to the same things. That stimulus isn't a fix to the weakness, it's a response to that same weakness. And the more that these governments have to do, and the more that central banks feel they have to cut, and the faster they feel they have to cut, the worse you know it is. And like a rolling recession, if the auto business is falling into it too, that would explain copper to gold, explain a whole lot, not just about the auto business, but what that means for conditions in the global economy. And copper to gold is corroborated by a whole bunch of deep fundamental indications, such as interest rate swap spreads that I talked about just recently. Those, the 10-year and 30-year swap spreads, those maturities have hit record lows themselves in the SOFR-based versions of them. But there's a good correlation and a solid correlation for very good reason between interest rate swap spreads and something like copper to gold, because they both mean the same thing. Whereas interest rate swap spreads mean lower growth and inflation expectations through lower interest rates into the future, rates that go down and stay there, copper to gold means the same thing from a very different angle, very different fundamental angle from the physical economy dealing with copper, as well as sense of danger driving hedging into gold. As is lower oil prices, despite the Chinese problem and the fact that Beijing is trying to solve the Chinese problem, oil prices continue to be weak. WTI in the United States just fell back below $70 per barrel yesterday on Friday, making it under $69 per barrel at one point. It's just not feeling the demand or good times are coming. It seems very much like the markets are preparing for example, autos to be that final straw. The half recession, the vibe recession, the rolling recession becoming just recession. And by the way, if you want to know about interest rate swaps and interest rate swap spreads, what makes them such critical indications and how to interpret them, I am putting together a basic series for Eurodollar University members. And right now we have our fall sale ongoing for Eurodollar University memberships, as well as our subscriptions, the daily briefing and the daily deep dive analysis. You can check all that out, what memberships are, what the subscription information is, and the pricing in our fall sale. It's all at our website, eurodollar.university. But it's not just interest rate swaps. It's not just copper and gold. It's not just oil prices. Now we're seeing an effect, especially of car makers and woes at automakers in the bond market. Credit spreads and even credit default spreads are rising where it comes to some of these big car makers as they confront weakness in their business, also a high level of uncertainty moving forward into 2025 when it was supposed to have been a recovery year. According to Bloomberg, just recently, a couple days ago, car makers' woes are turning into one of the global bond market's biggest pain points, with investors bailing out of the sector's debt as vehicle sales stall and competition rises. Well, competition rises because demand just isn't there. The sector has been hit on multiple fronts. In Europe, car makers have been hurt by weakness in major economies like Germany, as well as slowing sales of their vehicles in China. That the stimulus isn't really do much to help it. In the US, car sales fell in the 3 months to the end of September as high prices and financing costs kept customers home. Well, no, not really. I mean, high prices are a big part of it, but it's really about jobs and incomes, as we'll see in the data that we go over here today. Car sales began to soften, slow down, and then plateau when the unemployment rate started to rise, when hiring became more and more difficult. Americans perceived that the labor market was shifting, that it wasn't just slowing down into a Goldilocks soft landing. When you're more and more concerned about your job prospects, the last thing you're going to do is go out and buy some big ticket item like a house or a car. It didn't help that interest rates were higher, and it certainly doesn't help how high car prices have become, but the single biggest factor converting what were supply shock robust sales into now the second phase of the supply shock, that was all about employment and income fears. And as these conditions plague the auto business, there are a number of downstream impacts too in the industrial sector in particular that has been reeling for the last couple of years. Again, the rolling recession. Some parts of the industrial economy and really the services economy, just the entire system overall, have been weak, and then others parts would be weak, and they would just trade off back and forth, with the auto business being the one source of strength behind all of it, keeping it from going over the edge. But now it's starting to combine and synchronize, not just across the world, but also across industries. This is what Bloomberg wrote just yesterday. Meanwhile, Railroad CSX this week reported lower than expected third quarter revenue as faltering demand for coal, metals, fertilizer, and cars outweighed a recovery in shipments of chemicals and agricultural products. Automotive markets in particular have been a weak spot of late, and that's the big one. The industry has seen consumer demand diminished by high retail prices and interest rates, those again, not really, it's employment and income, which has led to higher dealer inventories and slower production, according to CSX's Chief Commercial Officer, Kevin Boone. Paint manufacturer PPG Industries also warned of a slump in automotive production in both the US and Europe, in trimming its organic sales and earnings outlook for the full year to the lower end of its previous guidance ranges. Continuing, the combined effect of all these mini recessions and job cuts is a general vibe of industrial malaise that's proved difficult to shake. Manufacturing executives have little incentive to paint a rosier picture right now. The slump started in consumer and housing-related products as the pandemic spending boom slowed unexpectedly. Remember, that was supposed to be a permanent plateau of prosperity. And then it spread to broader inventory hangover, freight recession that's still ongoing, and a chemical industry downturn that one executive likened to Lehman Part 2. So a worsening situation in autos is already having downstream impacts, not just on railroads, but suppliers and everywhere else across the industrial economy. And as the auto industry really begins to turn, which it hasn't yet, as it really begins to turn, that's going to pressure so much more than just car sales or car manufacturing. It's going to really impact everything else, which is one reason why we see a slump in car production preceding almost every recession. Car production goes down, usually well before the full recession hits, and then it becomes a bigger deal. And in the case of the supply shock, there's another factor that we have to consider, which is that the car business, as much as it was rapidly recovering from the lows in the pandemic, they were exceptionally low, and it never got all the way back to full recovery. It was short-circuited before ever getting there. I talked about this before in a previous video of what we've seen from Europe, and Europe's car business is in even bigger trouble than we're seeing just starting to emerge in the United States. Volkswagen talking about cutting factories and jobs in Germany for the first time in its history. And the reason is because Volkswagen, even the top officials said the demand isn't there. In fact, the recovery's not there. Volkswagen said Europe's car sales would not return to the 16 million sold across the market in 2019 before the pandemic disturbed global supply chains and semiconductor computer chip shortages, in particular slow car production. The market in Europe has recovered since then, but will not return to its former level, according to Volkswagen CFO Arno Antlitz. We expect around 14 million vehicles to be sold per year in the future, if at all. And that has nothing to do with our products or poor sales performance. The market is simply no longer there. So you have an industry that didn't fully recover from the pandemic, but while it was trying to recover, it was, as I keep saying, one of the few sources of legitimate strength around the industrial and really the full global economy. But now that it's well short of its recovery, a full recovery, it's now rolling over, which leads to a whole bunch of negative consequences. And we see the same thing in the United States. This is not just a European problem. The statistics we have on the auto business in the United States are weirdly similar when you don't realize that we're in a globally synchronized economy. It's exactly the same thing. For all of the hot rhetoric about what happened in 2021 and 2022, talk of a robust recovery, the car business shows better than anywhere, it was all a price illusion. People paid more for the same car, and car businesses were selling fewer cars but getting a lot more revenue. Now that the revenues are actually declining in a lot of these places, these car makers, these businesses, these companies and corporations take a look at what they're actually producing and saying, we don't need all of these people. We don't need all of these facilities because, as the guy said, the market is simply no longer there. So this is not just a simple cyclical downturn where a car maker business triggers a recession. Car maker businesses have to adjust and realign to the post-pandemic reality, which was never a recovery. So the market is simply no longer there in Europe, and the market is simply no longer there in the United States. When we look at the Bureau of Economic Analysis data for unit sales of automobiles and light vehicles across the United States, we see that they've plateaued around 15.5 million, a seasonally adjusted annual rate. That's the average sales level for 2023 and 2024. They stopped growing, they stopped recovering. The average between 2015 and 2019, which had been the peak rate during the 2010 silent depression era, that was 17.24 million. So almost 2 million seasonally adjusted annual rate below where he had been at the latter half of the 2010s. And the rate had been 16.9 million, the average of 16.9 million from 1999 to 2006. The auto business in the United States is well below where it had been even in the 2010s and the middle 2000s, which were hardly robust for the auto industry. You see the same thing too. Nominal retail sales, we got the report on Thursday. For automobile sales, those began to slow down and top out in September of 2023. As I said in the introduction, it's about unemployment and hiring. Once the labor market softened, suddenly there's not the same level of recovery in sales, which leads to a pullback in production. And as nominal revenues finally stop growing, they plateau. Production has to plateau, which means without the increase in nominal revenues and with production well short of actual recovery, all of these businesses are taking a second look at their costs, their investments, and really their utilization. They're saying we have too much capacity, we have too many workers, we don't produce nearly enough cars. And with the recovery being over with, we also have no way to get back to using all of these factories and workers. It's a key inflection point where businesses in the industry have to make some very hard choices because there was no recovery, and now the road to recovery has finally been shut down. When we look at automobile production in the US, this is part of the industrial production series by the Federal Reserve. What you see is that there's a sharp fall in auto production preceding recessions. Back in 2000, for example, heading into the dot-com recession, during the dot-com bust, from May to September of 2000, summertime being a weak point for the global economy as well as the auto business, May to September 2000, you see sharp fall in auto production. Before the Great Not Recession, a couple times before then, go back to the summer of 2006, again, summertime. From the summer 2006 into early 2007, the car business, car production falls off. Big time cyclical warning sign that even before we get to subprime mortgages and everything else, the US economy, the industrial economy is weakening substantially. And then there was another even bigger fall from May 2007 through the summer of 2007 into early 2008. So even before you get to the middle and worst part of the Great Not Recession, the auto business was saying this is not just about housing, nor is this about interest rates. This is about fears over everything, especially the labor market. So a big time slowdown in auto production, which is we're just getting those signs now, precedes these major full-blown recessions. And the fact that we haven't seen it before now is one reason why it's been kept to a vibe session, I hate that term, as well as the half recession. So the car business really just might be that final tipping point. We've had the rolling recession, which has been rolling along because some key industries have been still recovering. And the auto business was a huge part of that. Because it was late coming back from the pandemic, it was one of the few legitimate sources of strength the global system had. Now there are all the signs and all of the evidence increasingly points to autos finally hitting the wall and now moving into the same downside of the supply shock. Automakers themselves have some very hard choices to make. When revenues were rising and they weren't selling as many cars, that was one thing. But now revenues aren't rising and they realize that they don't sell nearly as many cars as they were hoping to. The pathway back to a full recovery has been short-circuited. So now they have to align production, employment, and everything with reality. And the reality of the downside of the supply shock, stripped of the price illusion, is increasingly an ugly one. And that's why markets like copper to gold ratios, swap spreads, oil prices that are not buying this stimulus fest, whether from China or central banks, that's why they're looking ahead and saying, don't like what we see. They called it a vibe session. I've called it a half recession. And if autos finally do go into that downside, it will be the full thing. We got recession signals in U.S. industrial production, and despite what the mainstream says about retail sales, they are sending the same thing. That's the video I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Still got the fall sale going on, so check that out. And until next time, take care.